Welcome, everyone. This is the American Dream Business Roundtable, and I'm Greg Noe, and this is my co-host, Catherine Raker. We're here with our guest, Mike McCormick, who is a CPA, and we're here to talk about business, of course, in particular metrics and key performance indicators. I know it sounds boring, but it's very important for businesses, and we're going to take the boring aspect out of it, as you'll learn. Catherine, I know you have some questions for Mike because you've never met Mike before until tonight.
No, and I'm going to give a little bio on him for our audience, if you don't mind. You know, Michael McCormick, CPA, President and Managing Member of Cincy Tax Coach, or MJ Cormick LLC. And he's described as a CPA 3.0 by his colleagues and much more than a bean counter. He's always looking out for his clients' best interest and searching for ways to improve their lives. He's honed his professional skills working with the self-employed, medical service professionals, manufacturers, real estate agents, and investors, property managers, and wholesalers. As a private company treasurer and controller, he was responsible for issues ranging from financial management, HR, and employee benefits to information technology and inventory control. And his diverse background and never-ending educational pursuits allow him to bring a well-rounded perspective to help you reach your goals. You know, you have a book out, too, that you did in 2010. And welcome to our show,
Thank you.
Michael. Nice
Thanks
to meet you. Tell us what that was.
The first book was The Entrepreneur's Guide to Forming a Business Entity, and it dealt primarily with, well, not primarily, exactly with, the steps a business owner goes through to decide what they think their business wants to be when it grows up. A sole proprietor, a corporation, an LLC, an S corporation. We don't specifically help someone decide what exact entity they need to be, but it helps them formulate questions to ask their professionals, their CPAs or their attorneys, so that they can start out on the right foot.
Well, you know, I started out as an LLC. Okay, I had been in a partnership, but then when I put that company to bed, and my partner wanted to not be a partner anymore and he wanted to retire, I decided through my CPA in New Jersey to become an LLC. So I became an LLC here. So I have some questions for you about this program that you've got.
Okay. And
one is, how would it apply to me as I would consider myself more of a sole proprietor since there's only one person.
That's right.
And it's me. Was that correct?
That's how it would be seen, correct.
Now tell me a little bit about what you guys are doing.
I would want to interject, but that isn't necessarily so because
Really?
Because sole proprietorship is actually a taxation method as well as an ownership.
Well, the sole proprietorship is the default tax classification of a business that has not made any formal elections or filings with the Secretary of State or the IRS. So that without doing anything, a business would be a sole proprietorship, or possibly a partnership if there are multiple people involved.
There's only me.
It's just you. So as a sole proprietor, you made an option by filing some paperwork with the Secretary of State to form an entity, to put a barrier around yourself called an LLC, a limited liability company.
Right.
Okay, and that limited liability company, and we're not here to talk about the legal issues, but theoretically puts a barrier up around you to protect you from various predators. From a tax standpoint, it really didn't change anything because you still file as a sole proprietor on your income tax return.
Right.
Now, as your business were to grow, that entity, that LLC, can make some additional elections to, as I say, dance a different dance. It can make an election to be taxed as a C corporation. It can further make an election to be taxed as an S corporation, which is probably the term that many people know is the S corporation. You don't see very many C corporations around anymore. There are some, and I work with many, but it's just not a common form of operation.
C Corps tend to be larger organizations. They're the Procter & Gamble's, General Electrics of the world. But the reason why LLCs are so popular is because of this flexibility.
That's right.
You can pay tax as a sole prop, then later on you can move and pay tax as a corporation, either a C or an S. Whereas if you incorporate it as a corporation, you only have two options, which is either a C Corp or an S.
Right.
You couldn't file tax as an S Corp. So that's one of the advantages of being an LLC. And while we're on the topic, let's cover it a little bit better. LLCs were really created to help those businesses that grow by bringing in partners. So they're uniquely designed for accountants, doctors, dentists, lawyers, and that's because you're allowed to divvy up profits and expenses according to a formula.
Right.
In an LLC. You can't do that with corporations. You must divvy up profits according to percentage of ownership. But for example, I can own 1% of an LLC and get 99% of the profits.
Really?
Oh, absolutely.
As long the formality of that is having it spelled out in the operating agreement, which is unfortunately what many small, and I think Greg would agree with, many small businesses skip.
They skip it?
It's their instruction manual that they can write themselves. It's the operating agreement between themselves, if it's a solo business owner or a partnership, is they oftentimes skip that formality of creating the owner's manual.
And there's a nuance in this that many people fail to understand, and that is, if you set up an LLC and you don't have an operating agreement, the state will provide one for you.
That's right.
But that isn't true for corporations.
That's right.
So if you set up a corporation with the Secretary of State, he actually doesn't set up the entity. What he does is he gives you permission to set up the entity back in your office.
Right.
And so when we talk about having the state create an operating agreement for you, we have to remember, let's use another analogy. If you don't have a will,
I was thinking the exact same thing.
the state has a will.
There is a default
You're
will.
going to take it away from me, right? Is that the deal?
And the provisions of their will may not be what you want.
That's
right.
And so you need to...
An example would be like the gentleman that died, that was the big singer from Purple.
Prince.
Prince?
Yeah.
What happened there?
Well,
He didn't have a will.
There's Prince, there's James Brown, there's any
so
number of
many of them.
celebrities that have died without having prepared their affairs appropriately.
Right.
But that's probably the most recent.
But the operating agreement covers the rules for the operation of the business. It tells everyone how the entity is to be taxed, how the owners can leave the entity, or how
a
new
new owner comes
members
in.
can come in, what the different roles are. Are you going to have a president, vice president, secretary,
right.
treasurer? Those kinds of roles. Is it a membership organization?
Is it member managed or manager managed?
All those kinds of things. And so we'll have to move on because that really isn't our topic for this
No,
evening.
that's not the topic, but it helps me understand what you're going to be talking about next, and that you're actually teaching, right, at the Excelsior Institute.
I'm planned to speak about performance indicators or key performance indicators, and Greg and I think Greg is scheduled to talk about business entities right now, but
Right. But that's what you're going to do eventually, correct?
And so I think we're going to have to move along for right now, but so for right now, we'll have to take a break so that we can visit with our advertisers and sponsors,
Right.
and we'll be back in a moment.